Imagine making over $11 billion in just 90 days, right?
Yeah, a massive quarter by any standard.
And then you look at the scoreboard and decide, you actually need to intentionally sabotage your own most popular products.
It sounds completely crazy. I mean, it totally defies traditional corporate logic.
You look at the very items printing money for you, and you purposely pull them off the market to orchestrate this massive drop in revenue because, well, that is exactly what Nike is doing right now.
Right. Usually when a company reports an $11 billion quarter, the playbook is just to protect that cash cow at all costs. But what we're looking at today is a company actively dismantling its own foundation to survive the next decade.
Welcome to the deep dive. We are unpacking Nike's Q3 2026 earnings report and the executive conference call that just dropped on March 31st, 2026. And look, if you think this is just some routine financial update, think again.
Absolutely not. It is a masterclass in how to deconstruct a legacy business model.
We are looking at a dramatic, real-time sports comeback story. We're going to explore how an absolute titan of global retail balances painful, short-term financial hits with long-term survival under this massive turnaround strategy they are calling Win Now.
Yeah, the numbers we have in front of us tell a story of extreme strategic rebalancing. It's about taking a massive hit to your pride and your stock price and somehow rebuilding without losing your core identity.
And that tension is the thread I really want you, the listener, to pull on throughout this deep dive. How does a company operating at an $11 billion quarterly scale act like a startup in the middle of a frantic pivot?
It's a really difficult balance to strike.
Okay, let's unpack this because Nike's CEO, Elliot Hill, gave us a really vivid image during the call to help visualize this exact tension. He talked about a recent trip to Barcelona.
Right, specifically standing on the pitch at Camp Nou, which is FC Barcelona's legendary stadium and a major Nike partner since like the late 90s.
Exactly. So Hill describes standing on the grass, and the stadium is actively being rebuilt around him. There's scaffolding everywhere. Cranes are looming in the corner.
Entire sections of concrete are just ripped up to accommodate this massive new 100,000-seat vision.
But the team is still playing competitive matches on the pitch. The fans are still in the stands cheering. I mean, they are trying to win today's game while contractors are literally gutting the infrastructure around the players.
And Hill told the investors, this is Nike right now.
It's such a wild visual.
It is, because they cannot afford to pause the business. A company of this size just cannot shut down its global supply chain, freeze its marketing, and say, give us a year to figure our identity out.
Right, they have to compete against aggressive upstarts every single day while undergoing these brutal structural changes. And when you look at the financials, you see the intense stress of that dual reality.
The stress is glaring. I mean, Q3 revenues were flat at $11.28 billion. In fact, they were down 3% if you look at it on a currency-neutral basis.
Wait, before we go further into the weeds there, currency neutral just means stripping out the effect of fluctuating exchange rates around the world, right? So we're looking at the actual volume of shoes and shirts being sold.
That is correct. It gives you the true operational picture, and that picture shows volume shrinking. Net income dropped a massive 35% down to $520 million.
Oh, wow.
Yeah, and their earnings per share, the EPS, which is the ultimate barometer of profitability for Wall Street, beat expectations at 35 cents, but a year ago, they were at 54 cents.
So profitability is just compressing rapidly.
Very rapidly.
I was trying to explain this dynamic to a friend earlier. It's like trying to execute a flawless Thanksgiving dinner for your entire extended family while contractors are actively gutting and remodeling your kitchen.
That's a great analogy.
You're trying to serve the turkey, but someone is pulling out the plumbing under the sink and the oven is like out in the hallway. It's a state of total chaos disguised as business as usual.
And what's fascinating here is why they are pulling out the plumbing. Those drops in revenue and profit are not accidental at all.
Wait, really?
Yeah, they aren't just losing sales because consumers suddenly forgot about the swoosh. Nike intentionally created what they call a 5-point headwind to their own revenue.
So they did this on purpose.
They did. They looked at their iconic, classic footwear franchises, shoes like the Air Force One, the Air Jordan 1, the Dunks, and realized there was incredibly unhealthy inventory in the marketplace.
Meaning there were just too many of these classic, highly coveted shoes sitting around gathering dust on store shelves.
Exactly. In sneaker culture, ubiquity is the enemy of cool. When an Air Jordan 1 is available in every single size, in every single mall, and constantly slapped with a 20% off sticker.
It totally loses its cultural cachet.
Right, the brand gets diluted. So Nike actively decided to restrict the supply. They pulled over $4 billion of projected revenue out of their financial modeling by drastically cutting the production of those classic shoes.
$4 billion. That is insane.
They purposefully took a massive financial hit this quarter just to protect the long-term desirability of the brand.
So they're bleeding themselves today to avoid a fatal wound tomorrow, but restricting supply on popular shoes is just one piece of this turnaround.
It's a big piece, but yeah, just one piece.
Because it's not just what they are selling that's changing, it's how they are getting those shoes to you. I was looking at the channel metrics, and the shift is really jarring. Let's talk about the great inventory purge and the total reversal of their pandemic-era sales strategy.
Ah, yes, the retreat from direct-to-consumer.
Look at these numbers. Nike Direct, which encompasses their own retail stores and their digital ecosystem, like the SNKRS app, saw revenues fall 7%. Digital alone plummeted 9%.
Well, at the same time, wholesale grew 1%.
Yeah, and an absolutely massive 11% in North America. Plus, to facilitate this massive pivot, management just booked a $230 million severance charge, heavily concentrated in their supply chain and tech divisions.
It's a massive unwinding of their previous strategy.
Okay, wait, I have to push back on the strategy. Because for years, the entire retail industry preached that cutting out the middleman and owning the direct relationship with the consumer was the holy grail of retail.
It was definitely the golden rule for a while.
Right. Direct-to-consumer, or D2C, was the absolute gold standard because you keep all the data and all the margin. So why is Nike suddenly paying hundreds of millions in severance to reverse course and go back to the very wholesale partners they walked away from?
Well, to understand why the DTC dream turned into a nightmare, we really have to look at the unglamorous mechanics of supply chains.
Break it down for us.
During the pandemic boom, Nike went all in on D2C.
Right.
But to do that, you cannot just use your old warehouses. You have to build a massive, incredibly complex, fixed cost structure.
Okay, meaning what exactly?
Meaning you need specialized distribution centers tailored for individual parcel shipping. You need armies of customer service reps to handle returns. You need massive tech investments to keep the apps from crashing.
Right.
That is all a fixed cost.
Yeah.
You pay for that massive infrastructure whether you sell one shoe or a million shoes.
I see. So it's the difference between owning a massive fleet of delivery trucks versus just buying a FedEx label when you actually need one.
That is the perfect way to visualize it.
During the pandemic, Nike basically bought the whole fleet, but now that consumer demand has cooled off, they are stuck paying for thousands of empty trucks.
Yes, it is the trap of total control. When demand drops, that massive fixed cost base just crushes your profit margins. So this $230 million severance charge is Nike taking a sledgehammer to that fixed cost structure.
They're aggressively trying to variabilize their costs.
Exactly.
Meaning they want costs that scale up and down organically. If you sell more, logistics costs go up. If you sell less, those costs disappear, which protects your bottom line.
And the absolute best way to variabilize your distribution is leaning back into wholesale partners. From a unit economics perspective, shipping 1,000 pairs of shoes on one giant wooden pallet to a Dick's Sporting Goods or a JD Sports is incredibly cheap.
Super efficient for Nike.
Highly efficient. You drop the pallet at the loading dock, and you let the wholesale partner pay for the store lease, the sales associates, and the headache of individual customer returns.
You essentially outsource the most expensive part of retail, the last mile, to someone else.
Precisely. And beyond the logistics, there is a harsh consumer reality Nike had to accept. An integrated, balanced marketplace meets the consumer where they actually are.
Right, because not everyone wants to be forced into a single, enclosed digital ecosystem.
Yeah, sometimes a teenager just wants to walk into a mall with their friends, try on 3 different brands of shoes at Foot Locker, and walk out with a box.
And by starving their wholesale partners of product over the last few years, Nike left massive market share on the table for competitors to scoop up.
They absolutely did.
So they are tearing down the bloated D2C supply chain, they are restricting the supply of the Air Force One, and they are returning to the mall. We see the demolition clearly, but you cannot cut your way to growth.
No, you definitely can't.
So what are they actually building to replace the revenue they are destroying? Let's transition from the business mechanics to the product pipeline.
The new foundation they are pouring while the stadium is under construction.
Here's where it gets really interesting. Because when you strip away the supply chain drama, this is fundamentally a sports company. And their new sport offense is showing massive proof of life.
It really is. I mean, Nike Running, which had been bleeding market share to upstart foam shoe competitors for years, surged over 20% this quarter.
That's a huge jump. And global football is revving up for the 2026 World Cup, too. They just launched the Tiempo. The new Mercurial drops in June, and they have these new Aerofit kits.
Including a special Jordan away kit for the Brazilian national team, which is a massive cultural moment.
It feels like an F1 team that got way too distracted selling team jackets and branded lifestyle merchandise and suddenly looked at the standings and realized they need to get back into the garage and just build a faster car.
That is exactly the vibe. Elliott Hill is engineering a massive cultural reset. The mandate is clear performance drives the brand. If you don't win on the track, you eventually lose on the street.
I saw they are heavily leaning into a new technology platform called Nike Mind, which honestly sounds completely sci-fi. What exactly are they building in that lab?
The Nike Mind platform is a fascinating pivot toward the psychology of performance. It is backed by over 150 patents globally.
150 patents just for this.
Yeah, they aren't just looking at how a shoe strikes the pavement anymore. They are looking at how an athlete processes sensory input. The tech is designed specifically to clear pre- and post-competition distractions.
So we are talking about apparel utilizing like advanced thermal regulation and sensory isolation features.
Exactly, and proprietary fabrics that manage the physiological stress of competition. The first product, the Mind 001, completely sold out globally within hours.
Wow. And they had to immediately double production capacity, right? Plus, I saw 2 million consumers signed up for Notify Me alerts on the website.
2 million people waiting for a highly technical performance product. That is a massive demand signal.
They also unveiled Aerofit for their football lines, which is a cooling platform that increases airflow by 200% over their legacy dry-fit technology.
And they are even taking Nike Air, the actual pressurized gas technology, inside the soles of the shoes and using it as a self-inflated thermal layer in cold weather apparel.
Taking a proprietary footwear patent and repurposing it into apparel is just brilliant engineering. But we have to ask why all this deep, geeky, highly expensive athletic tech matters for a company that makes most of its money selling lifestyle sneakers.
It really comes down to the mechanism of the halo effect.
Walk us through how that mechanism actually works. Like, how does a sensory deprivation hood or a track spike sell a pair of everyday walking shoes?
True athletic innovation legitimizes the entire corporate umbrella. When Nike spends millions developing a shoe that helps an Olympian shave 1/10 of a second off a marathon time.
It proves they are the absolute apex predator of athletic engineering.
Exactly. And that credibility cascades down. The everyday consumer, the person who just wants comfortable sneakers to wear to the grocery store, buys the mass market version because it carries the halo of the elite version.
Aspiration drives mass market purchasing.
Absolutely. The everyday buyer wants the psychological edge of wearing the brand of champions, even if they're just running errands. The sport offense validates the sportswear business.
So having the best, highly patented cooling tech in the world is crucial. But having the best product doesn't matter if geopolitical forces make it too expensive to ship or sell.
That's the harsh reality of global business.
Right, because executing this comeback on a whiteboard is easy, but executing it in the real world is incredibly messy.
Turnarounds never happen in a vacuum. You are constantly fighting the weather.
Let's look at that global reality. Gross margins, the profit they make after the direct costs of making the goods, dropped to 40.2%.
Which is a significant hit.
And a massive part of this was a 300 to 650 basis point impact from new U.S. tariffs.
Wait, 650 basis points for those of us not looking at a Bloomberg terminal all day. A basis point is 1/100%.
Correct.
So that's a 3 to 6.5% massive hit to their profit margins purely from new import taxes, right?
Yes. It was an external shock to their cost of goods sold that they have very little control over. When tariffs hit at that magnitude, it instantly evaporates a massive portion of the profit you modeled for the quarter.
Yet, despite that heavy tax burden, North America is actually serving as the blueprint for the comeback right now. Yeah. They showed positive growth across all channels in February.
The medicine is definitely working at home.
But you cross the Atlantic and EMEA, Europe, the Middle East, and Africa is struggling badly, Revenue's down 7%. The market is highly promotional.
which means competitors are slashing prices, forcing everyone to discount heavily just to move product.
Plus, they are burdened by severe supply chain and retail traffic disruptions in the Middle East. The macro environment in EMEA is really forcing them to play defense.
And then there's Greater China. Revenue is down 10% there, and here's the crazy part. Nike is intentionally forecasting a brutal 20% drop in Q4 for Greater China.
Yeah, they are actively orchestrating a massive sales plunge.
To aggressively clean up the digital channel and age inventory there. Aged inventory is exactly what it sounds like, right?
Sure.
Old stock that has been gathering dust in warehouses for seasons, tying up capital.
Yes, and the mechanism of clearing aged inventory is painful but necessary. So you leave cheap, old shoes flooding the Chinese digital marketplaces.
It completely cannibalizes the sales of your new full-price premium innovations.
Exactly. Consumers will just buy the discounted old stock. So to fix the market, you have to flush the pipes completely, even if it means accepting a 20% revenue plunge for the quarter.
And they are replacing that digital bloat with a hyper-local physical strategy. They are launching a very specific 100-door store pilot in Shanghai.
The Shanghai pilot is crucial because the Chinese consumer market has evolved. A one-size-fits-all digital strategy no longer works there.
They require hyper-local, community-driven retail.
Right. By focusing on 100 specific neighborhood doors, Nike can obsess over local storytelling, highly targeted replenishment, and cultural integration. It's a surgical strike to rebuild brand prestige in their most complex market.
They did mention one bright spot globally amidst all this regional turbulence, though. The ACG line All Conditions gear is crushing it at the Winter Olympics in Milan.
Oh yeah, the ACG campaign was fantastic.
They even commissioned an actual All Conditions express train running to the Alps to build hype, which is just undeniably cool marketing.
It proves that when they get the storytelling right, the consumer still responds with massive enthusiasm.
So what does this all mean for a global giant? How do you manage a cohesive global brand when your home turf is getting slammed by tariffs, Europe is heavily discounting just to survive, and you're actively orchestrating a 20% sales plunge in China just to clean house?
Well, if we connect this to the bigger picture, it tells us that global turnarounds are not monolithic. You cannot apply a single brushstroke to the whole world.
You have to fix the plumbing, room by room, market by market.
Exactly. Financially, executive management is just trying to hold the line until these massive macroeconomic headwinds begin to normalize.
And CFO Matt Friend noted they are targeting Q2 of fiscal year 2027 as the inflection point, right?
Yes. That is when they project the supply chain will be clean, the impact of the tariffs will be absorbed or mitigated, and gross margins will finally start expanding again.
So for you, listening to this deep dive on your commute or at your desk, what is the ultimate takeaway? Think about your own career or a major project you're leading right now.
It's really about perspective.
Exactly. How often do you have to accept a deliberate, public, short-term failure to build a foundation for sustainable future success? I mean, Nike literally cut $4 billion in guaranteed revenue from their most popular classic shoes because it was the right move for the brand's survival in 2030.
They are taking a severe beating in the headlines and the stock market today to protect their cachet for the next decade.
It's wild to watch.
It takes immense corporate courage and an incredibly understanding board of directors to execute a win-now action that looks exactly like losing in the short term.
They expect to have the heavy lifting of this restructuring finished by the end of this calendar year, but the discipline it takes to stay the course while the stadium is torn apart around you is remarkable.
Truly remarkable.
But as we wrap up, there is one tiny detail buried deep in this earnings report that I cannot stop thinking about. It's about Converse.
Converse, right.
Nike has owned Converse for decades. In this quarter, Converse revenue was down a staggering 35%. Structural changes and layoffs are underway there too.
It's a tough time for that brand.
But here's the provocative thought I want to leave you with. As Nike aggressively pivots back to elite performance, 150 patent technologies, athlete-led innovation, and the sport offense, what happens to a beloved brand like Converse?
Well, Converse has absolutely zero to do with elite athletic performance. It is entirely driven by lifestyle and heritage.
Exactly. Converse isn't about carbon fiber plates or 200% airflow. It's a purely cultural brand built entirely on street art, skateboarding, and music.
It is a completely different world.
So, can a brand built on Kurt Cobain and garage bands survive inside a massive corporate machine that has suddenly remembered its primary mission in life is to win Olympic gold medals? Is Converse fundamentally incompatible with the new, ruthless, performance-driven Nike?
It is a profound culture clash happening under one corporate roof. When you optimize a machine purely for speed, anything that doesn't make the car faster is eventually viewed as dead weight.
It really is. We started this deep dive talking about a legendary athlete who stumbles and has to reinvent their game to stay on top. Nike is clearly back in the gym, tearing down their swing, rebuilding the stadium.
But as they strip away everything that isn't focused on winning, you really have to wonder what gets left behind in the locker room.
Keep questioning the playbook, and we'll see you next time.